Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Jeroen Van Doorsselaere of Wolters Kluwer Financial Services. And we're going to talk a little bit about the International Financial Reporting Standards. So the deadline for these standards is 2018. So what changes will these rules bring to the accountancy industry?
Well, you actually have three phases within the standard. One is about classification and measurement. The second one is about impairment, and the last one is about hedging. The first one, the impact will be that instead of going to a more rules-based on where everything going in, it will be more principle-based, where you start in a fair value category, but then we'll have to prove a cash flow characteristic test, a business model, as well as some irrevocable elections where financial instruments belong to. The second phase is about expected losses. There you actually had the move from incurred losses to expected losses, and more specifically towards a more forward-looking point of view, which includes lifetime expected losses and different credit models, which will impact both finance and risk departments. And thirdly, the phase 3 is hedge accounting. Hedge accounting as such is not really mandatory in 2018. However, a lot of banks will actually have benefits of doing it because it will have more eligible instruments to do. And when the PRA, it's a portfolio revaluation approach, will actually be there, then it will actually move banks towards completion with the general hedge accounting rules as well.
So what do risk and finance departments need to consider in order to meet the compliance deadline then?
Well, first of all, I think the major challenge is working together, where in risk you have a more snapshot-based approach where you do models and work against capital requirements limits. Finance departments will actually have to build models on top of that to actually overcome all the balance sheet impacts, including P&L, which in the long run have even an impact on share price. At Wolters Kluwer Financial Services, we really believe you should have a kind of a base in which these models integrate in a historical auditable environment, in which, of course, from a finance perspective, this is a very normal way. However, from a risk perspective, this means that your models become part of the accounting policy, which of course means that this will impact in the future. So you actually have a comparison between the flexible risk management calibration of models and the more fixed auditable accounting policies in models. Second challenge will be on resourcing, because IFRS 9 requires skills in the credit risk as well as in the finance department, which of course creates kind of a hunt for resources which knows a bit of both and how to unify those. Then thirdly, of course, the expected loss models, leaving alone hedging for the moment. Expected loss models also require macroeconomic factors, which of course extend the existing risk models, but also have a serious impact in the sense of finding those, recalibrating the models, go for a lifetime expected losses instead of a 12-month expected losses. And last but not least, don't forget these expected losses as such, which is the major impact for financial institutions regarding this, do have a significant impact not only on the P&L, which is of course the most visible, but also on capital requirements, but also on the reputation of boards, because it's actually looking into a glass bowl. However, it is forward-looking. No one can actually see what's going to happen. So actually the reputation of the boards is on the line. So in that way, you have to create an organization, or let's say also from Wolters Kluwer Financial Services point of view, to create a system which actually can calibrate the necessary defendable positions a board can take in taking the expected credit loss to a level which is auditable and acceptable by the regulator.
So, with any sort of standard that gets rolled out in different jurisdictions and geographies, there's a risk that there'll be disparate definitions. So how can you really avoid regulatory fragmentation with the IFRS?
Well, first of all, the risk of having fragmentation is quite big in this sense. Why? First of all, IAS 39 was already principle-based, but had still some examples which had to be followed by the rule. While in IFRS 9, everything is principle-based, which means it depends a lot on interpretations across the globe. And as we know, there are some regulators. There are actually two kinds of regulators, if you want. There's one regulator that will say, no, I don't like principle-based. I will set my own rules in my local standards, and banks will have to follow that. Secondly, you will have the jurisdiction that says, okay, you can keep principle-based, you can develop your own models, but we will come inside of your financial institution and check the models that you're doing. And then thirdly, of course, that also means that banks will have a global kind of approach, but also a more regional point of view, because if you are a big bank, you will have different jurisdictions where you have to comply to. And then secondly, and that's maybe unique in this case, is that the banking or the Basel Committee for Banking Supervision also made additional guidance on this IFRS. So you have a risk regulator, or let's say a regulator which more focuses on the risk side of the story, giving commons guidances on the expected loss side, which are actually more strengthened or more strict than the IFRS 9 rules itself. But of course gives an additional challenge, because they actually put the banks forward to say, the more you comply, the better reputation you will have. And if you're a big bank with a decent reputation, you don't follow what IFRS 9 would call practical expedients to follow forward. However, the practice, of course, compared to the theory, must also be said. I think in all jurisdictions, you always will have flaws because some data is not available. In the UK, we are blessed, for instance, with a lot of macroeconomic factors which are available on the market. You can imagine in the Middle East, Asia, that there are countries there that doesn't have this battery of macroeconomic factors in the market, which makes it much more difficult to actually comply to a forward-looking view within the accounting standards.